Okay, good afternoon and welcome to this web conference with Movinn. Today we have Patrick Blok, CEO of Movinn, presenting this third quarter of 2022. My name is Johan Larsson and I work at Västra Hamnen Corporate Finance and I will be the moderator for today. So today we'll start by, Patrick will start by presenting the company's quarter, and then after that we will have a short little Q&A where I will ask some questions of my own, and I will try to answer all or ask all the questions from the audience as well. So with that said, if you have any questions, please write them in the question field, either during the presentation or during the Q&A, and I will ask them. And lastly, I just want to inform you all that this session is being recorded, and it will be available on both Movinn's homepage and Västra Hamnen's YouTube page after this. And with that said, I'm going to leave the word to you, Patrick.
Thank you, Johan. Thank you for hosting this for us. It's been another quarter, and it gives us the opportunity to give everybody a state of the union, so to say. So we'd be happy to run through it, and I'll just dive right in. I'm not gonna do the normal kind of introduction to what we do. We've done it earlier, but I can, we're a property company doing service living. We have this ambition to grow cross-border. Very big part of our current strategy is to take the existing Danish foundation and then build subsidiaries on top of that, taking us to key European markets, and that's like the main part of our strategy to maintain growth and obviously deliver promised results and also deliver on an international expansion. So that's what we're spending a lot of our time currently doing, and it's going fairly well, and I'll run through it. Our total unit increase year to date, or not year to date, but at Q3's end was 115 units. We have another 25 units in the pipeline for Q4 that will take our total unit growth this year to 140. It's a good deal above our guided targets, so that's why we've been out and in the Q3 report revised our guidance. I'll come back to that later. We have launched a second international market in Lund, Sweden, which means that we are now operating in both Malmö and Lund, and covering those two markets is very important in the south of Sweden. Those two are the key markets. We are preparing for a launch in Germany as well. We've been communicating this earlier. Germany is obviously a major market of major importance in Europe, the most populous country, the largest economy, one of the largest economies in the world. So it's very natural that we are looking at Germany, and we are doing the initial exercises on this market as well. Because our unit growth has been so aggressive, we will be using the early quarters in 2023, Q1 to Q2, to optimize and consolidate our existing portfolio. We then expect to resume more aggressive growth later in the year, but we want to do this exercise because we're so far ahead of our growth curve, and we want to show the market that we can generate some interesting free cash flows on the existing business, and then resume aggressive growth at a later stage. We also expect this exercise to improve on metrics when you take into account that we have the seasonality pattern that we have communicated earlier. But basically this quarter has been a busy one as well. We have added 32 units across the group. Some of them is in Lund and some of them is in domestic markets. We've had a top line growth of 29%. We have an EBITDA margin on the Danish business on 14.8%. Our EBIT margin is 6.6% from the existing Danish operations, and an annualized return on invested capital is 16%. Just to remind everybody why we isolate the Danish figures is because we guide on the Danish figures. That's major part of the existing guidance, so that's why we have segmented the numbers so everybody can keep track on what's happening in Denmark and what's happening on group level. Obviously, the group level will be better top line wise, but there'll be some tear on bottom line margins. It is as expected. Every time you launch a new market, there'll be a cash burn, there'll be a market penetration rate and stuff like that. So that's why we segment the numbers in that regard. We're also showing the 9 months year-to-date figures, so people can, and that's also on the Danish business. This is for all interested parties to keep track on the performance in line with the guidance principles that we have put in place. The group structure is developing, and naturally, because we now have a commercial launch in Sweden, so obviously we have a Swedish subsidiary. We've also prepared for a commercial launch in Germany, doing a lot of the initial exercises legally to kind of prepare everything and make everything ready for commercial launch. As mentioned earlier, we have launched in Lund and in Malmö, and we're now looking to broaden our reach in other key Swedish cities. And in parallel with that, we're working on pretty intensely on a German launch. There's nothing specific to report yet, but obviously when there will be, we will relay that to the market. So this is our current group structure. It's evolving according to plan. So the highlights. This is a bit similar to what you saw earlier, but we'll run through it. This is the segmented income statement. As you can see, we have realized revenues of 19.2 million in the Danish operations. It's a bit higher on the group level. This is because we are starting to get the Swedish market up and running. It is a 28% change if you look at it from the Danish operations, and it's a 29% if you look at it from the same period last year and up until the group level. We have realized an EBITDA from the existing operations on 2.8 in Denmark and 2.4 on the group level. And again, this is due to the current cash burn that we're chasing to break even point, so to say, in Sweden. We will get there. We expect to get there soon, but right now there is this timing relay where we incur some costs before we can generate the revenues to kind of support the cost structure. Our EBIT on the Danish operations is 1.27. It's 800 on group level, roughly. It's a slight decline from last year, the same period last year, and where we did 1.4, and that is mainly due to the listing costs that we also report separately. As you can see, we have 292,000 in the quarter on listing costs, and this is advisor fees, all this fees all this kind of costs related to being a listed company. We're isolating these numbers for more transparency. That takes us to retained earnings, which is on the positive side. We're obviously happy with that. It's 800 on group level and 800 on the Danish operations and 446 on group level. So we're trying to balance stuff as well as we can. It's still doing high double-digit growth. Obviously, tears a bit on everything, but we're happy that we can display profitable growth. This is in line with what we promised the market when we went public, and this is in line with what we've reported ever since we went public. Maintaining fairly substantial growth, but doing it profitably. So we are following the plan in that regard. Our balance sheet is evolving as well. If you compare the figures for last year, obviously the balance sheet has changed quite a lot, and this is due to the fact that our IPO was completed in Q4 last year. So the entire the impacts that the IPO had on the balance sheet is obviously not in the comparable period. So a lot has happened. Our equity ratios have been improved. We are servicing our debt. As you can see, the debt is going down, and our balance sheet has doubled more or less since the comparable period. Sorry. If you look at the cash flow statement, I've taken some key highlights from the cash flow. You can see that the cash flow from our operation is not as impressive as it was last year. This is due to several facts. One of them is that we're obviously burning, because this is a consolidated cash flow statement. This is taking the cash burn into account that we incur on international markets. And because we are also spending and investing in Germany, there's a strain on our working capital in that sense as well. So the cash flow from operation is temporarily affected by these two circumstances, but it is expected to improve in the next periods, of course. Our total investments comes to 3.4 million. Our financing has a smaller net positive effect of 360. This takes our net change in cash flow to 2.9 million, which is then resulting in a closing balance of roughly 17.3 million Danish in the bank account. So this is kind of in line with what I mentioned earlier, that we expect to use the next quarters, in the early quarters in 2023, consolidating, not being as aggressive as we've been year to date. This is expected to generate some attractive. We expect to generate a free cash flow, and we expect it to be fairly attractive. And so basically, we'll be putting our investments a bit on hold to kind of catch up with everything in all the existing markets. The key ratios is also showed on a segmented level. There's a comparable period from last year, and there's a year to date in the far right column of the table. We see improvements from earlier reported periods this year. We see a slight decline on bottom line metrics compared to the same period last year. You can see that the EBITDA is 3.7 lower, the EBIT is 5.1 lower, etc. Again, it's due to the fact that we have more costs. There's the listing cost of being a publicly listed company that we didn't have in the comparable period. And then we have the burn from the Swedish operations that is obviously also having a negative impact on the bottom line metrics. But it is as expected, it is as planned, and we can see that the Danish operations is more or less in line with our long-term value driver guidance. I'll come back to that earlier, but you can see that we have an EBITDA margin of just shy of 15%, which is in line with long-term guidance, and we have a ROIC of 16%, which is just shy of the long-term value driver guidance that we offer to the market. So in general, we're happy and satisfied. Everything is going well, and again, a profitable growth is one of the key takeaways and one of the major promises that we made, and we're happy to deliver on that. The operational data, this is again to display as much transparency as we see fit, so the market can keep track of what's happening and where we're evolving. You can see our unit growth has been fairly substantial this quarter and also year to date. So we have added a large amount of new units, both domestically and abroad, which has been funny, but also a bit straining on the organization, of course. So we're trying to balance it all the time. Obviously, we want to keep growing, and that's still the plan. No changes there. But we also want to exploit the fact that we have been so far ahead of our growth curve to kind of demonstrate a new exercise to the market, and that is the free cash flow exercise. So that's next. Other than that, we have some operational data which is in line with the long-term value driver guidance as well. The revenue per unit is within the guided range. The vacancy is below our 10% threshold. So in general, everything is working well. As you can, if you look at the group level, again, there are some deteriorations. That is due to startup costs. The guidance, this is taken directly off the Q3, so it's a bit text heavy. Please forgive me for that. But basically, most of the points remain unchanged. other than our growth investments and our pipeline in the existing markets. Our pipeline has been revised upwards, and we expect to exit the year with roughly 95 to 97 units in Denmark alone, which is 46% higher than the original guidance. So that's an upwards revision. Because the growth has happened so late in the year, it'll have a limited impact on the current year's financials. That's why the other guidance points have not been changed. However, obviously it'll give us a better starting point going into the next year, and so having secured this growth already is expected to be good for next year's metrics. The market outlook, it's taken directly from the Q3. We have the seasonality. This is a constant thing for us, where we have ranged the quarters so everybody can see how the quarters is performing historically. We are obviously doing a lot of work to improve on our seasonality patterns, and it's not a massive impact it has, but there is some seasonality, and we'll do whatever we can to kind of offset the seasonality impacts we might occur. But basically Q4 is historically a weaker quarter, and the same is Q1, where Q2 and Q3 is historically the best performing quarters. Demand remains stable. This is a positive thing for us, of course. It's no secret that there's a lot of unrest in the world, both political and economic uncertainty. We don't see any effects on our demand side, despite this fact, which is positive, and we don't expect this to change in the foreseeable future either. We are in regular talks with our larger clients. It doesn't look like their needs will change in the foreseeable future, so that is a positive thing. So hopefully we can cruise through any potential slowdowns we might incur on like macroeconomic scale. Hopefully we can maintain our positive trend line. We have added a lot of supply, as mentioned. We don't know how fast and when this growth will occur. Now we've had a very productive year. We expect this to continue, but with a bit more control maybe than what we've been used to. We have launched the new markets in line with expectations, which is great. We're working on Germany and the key Swedish cities. Continue to do that, and hopefully we can do some launches in those cities as well. We'll keep doing that work. That will not change at all. Inflation is a factor in everywhere you look. Everybody's talking about inflation. Inflation is not a good thing for us in the longer run, because it'll dilute our clients' purchasing power, as it will in all industries. So we're monitoring this closely, and hopefully we can and managing this closely. We are doing some dynamic changes to our pricing structure. We are doing all these kind of boring exercises, trying to of course maintain our margins, but still be highly competitive and highly price sensitive, so that we can compete in the long run. Energy prices is also on the rise. It looks like there are some improvements there, which is a positive thing. The same with bottlenecks. We experienced that earlier in the year. We had some of the FF&E that we source from factories all over the world. The lead time was longer. This means that we are buying larger bulks and kind of stockpiling in our warehouse, so we are able to keep growing without having any bottlenecks in shipping lanes, for example, to be a stopping factor. So we are managing the risks fairly well, I would say. And again, we don't expect the demand side to change in the foreseeable future, which is also positive, very positive. The product portfolio, you've seen this before. It's had a bit of a facelift, one could argue. But basically the product groups are the same. We have our major core product, which is service departments, very heavily used in corporate housing. So the entire onboarding of the international workforce will happen in normally happens in service departments. If people are here for 6 or 9 months or whatever, this product is very well suited for that. We have our smaller product group, which is co-living. It's an emerging market. It's a very interesting market. It's also a very interesting market in Sweden, and it is across Europe. It's basically people sharing apartments. So it's this service community where you can also get some social comfort and meet some new friends. I've seen somewhere in the Swedish media that it's being hailed as one of the means to solve to take some pressure off the housing supply. So in general, it's a very good segment for us, and it's growing fairly quickly within our total growth, as you can see from the table. It has grown 150% since the comparable period last year, and where our service department segment has grown 24%. So it's actually growing faster than our core concept, core product. The furniture rentals is our third little product group. It has been neglected this year for sure. We've had so much growth on the core segments that the commercial launch of the furniture rental has been postponed. And so it's pretty according to schedule. Obviously, we wanted it to be a bigger segment now. Right now, there's nothing really, no activity. We have tested the product. It's working fantastically well. It's a good supplement to activating our working capital. The items we have in stock, and it's a good supplement in our market in general, because there's a lot of synergy effects between the different segments. We expect to spend, when we kind of slow our growth down on the core segment in the next couple of quarters, we expect to give the furniture rental the full attention it's needed, and the entire IT infrastructure and all that will be ready, so we can start to push that product as well. Our client concentration, we display this as a way of showing you the risk management, because we have larger clients, large international companies, very large Danish C25 companies. Being a B2B supplier in general, that exposes you to having client concentration. So basically, you don't want too much of your revenue being tied down to one client, because that'll expose you to a risk if that client for some reason is either scaling down or it has a temporary demand shock or whatever that makes them not need your product. So we show this as a way to ensure everybody that we are pretty well diversified. As you can see, our largest client it's a Danish C25 company. We have a no-name policy, so we don't flash any names in our portfolio, but they are currently representing a 3% revenue stake, which is within the internal boundaries that we have set, and it goes down from there. So we are well diversified, and that will allow us to both grow together with our existing clients, but also take in new clients without being exposed to too much risk on our demand side. Our tech development is moving along as expected. As we have communicated earlier, we have a tech development. We have an entire, it sounds a bit fancy. We have 4 people working in-house on tech development. It is an important part of our operations. It's an important part of our growth. It allows us to be extremely lean on the way we grow, but also allows us to deliver a good experience to our clients. So there's a lot of automation. There's a lot of IoT products. Then a very large part of our value chain is being completely automated by our tech products that we have developed in-house. So that remains a key focus. That remains something that we invest in, and we'll keep doing that. And again, going into a market like Sweden, obviously there's differences from Sweden to Denmark. So instead of having an external company that you need to hire and have you and spend money on that, which will be more expensive, no matter how you look at it, we can develop it in-house. We can make the smaller tweaks and turns that is needed to be operational in Sweden fairly quick. And the same exercise will apply in Germany. There will be differences for sure, but we can adjust everything in-house. We also have our own furniture production. I've called this slide improving ROIC. It's basically having a lot of furniture and fixtures and equipment is a pretty substantial investment item on our balance sheet. So having the production in-house allows us to source products directly from factories, meaning we don't have any middlemen. So we have designed everything ourselves. It's designed with the specific purpose of being very well suited for service living. It's designed to from a spare part logic where you can change things fairly efficiently. This means that our ongoing reinvestment is also limited compared to if we bought items from a third-party vendor. And obviously we also had this desire to stand out a bit and be a bit harder to copy. So instead of buying normal household names, we wanted to do our own design concept. It's working out well. It gives us it gives us this iconic feel, and it limits our investment needs now and going forward. The current markets we're in is also shown, complete with unit numbers divided by the different product groups we have. You can see that we have shown all the cities that are currently online, or what we call it, on our platform, with complete with unit numbers. We also show the pipeline end of year, so you can see that we have 25 units in the pipeline. And then we also show you the long-term pipeline, which in this case is the net pipeline, 36 months into the future. When I write net, I mean that if we are to give units back, that would obviously have a negative impact on our unit growth. But it doesn't look like that is a thing. It looks like we keep adding to the portfolio on a net basis. And again, sorry, I'm just going to go back again. The 140 new units end of year across all markets, that's fairly substantial. It's above the guided target. It's a lot. Last year we did in the 70s, so it's 100% increase from what we did last year. New markets in focus. This is a major deal for us. It's in line with what I've mentioned earlier. We have a pretty good foothold in the south of Sweden, and we are now looking to branch out to the major. Skåne is a great market, but obviously the cities of Göteborg and Stockholm is larger, and there's more commercial activity. So it's important markets for us for sure, and it's the markets we have in our sight in the next steps. And hopefully it will materialize soon. Again, it's a bit out of our, it's not completely within our control how fast we can do the launch, unfortunately, but we are working on it very intensely. We also have Hamburg as the focus, specific focus. Again, Germany is a whole nother ballpark. No offense to Denmark, no offense to Sweden, but Germany is just massive. So it's of vital importance to us that we can export the concept to Germany, and we are again working on that intensely. We have this target of some minimum thresholds we wanna keep, and then we show the pipeline. Right now, there's no specific projects in the pipeline, unfortunately, but we're hoping and working on that soon. Recapping on the roadmap to 2025, this is the midterm, short / long-term strategy, you can call it. It's being boiled down to 6 value driver, key value drivers that where we do long-term guidance. This is the only long-term guidance we do. We don't do long-term earnings guidance, and that's completely deliberate. We don't want to put any earnings. We don't want to put this long-term pressure on delivering stuff because there's so many uncertainties that it doesn't make sense for us to do long-term earnings guidance. It'll only incur us to employ short-term tactics. There'll be more negatives in my opinion than there'll be positives. But these value driver guidance, if you want to sit down and do a model, you can easily recreate our cash flows from these 6 value driver guidance. It'll take you some time, but this is This is what we expect, and this is what we aim to deliver in, on an improving basis year on year. So it's the portfolio growth, it's the 20% compounded annual growth at home, it's the 1 to 2 new cities a year. The new markets is important. It's the unit metrics. One apartment has a revenue potential, and so having to show you our unit growth is important if you want to get a better long-term understanding on our revenues. An EBITDA margin above 15% is the long-term aim, and if you look at what we report now, we are at 14.8, so we are getting there already, which is good. The operational vacancy, also an important value driver. If you have too much vacancy, obviously the apartments are sitting empty for a larger period during the year, and that will have a negative impact on the revenue potential in an apartment. So that has to be below a certain threshold. It'll never go to zero, because in our business model, we always need to be able to deliver. So vacancy is part of it. It's part of being flexible. It's part of being a good long-term partner to large companies, because their need is always a bit urgent and a bit short-sighted. So we need to be able to deliver at all times. So vacancy is part of the business model, but it can't be too high, obviously, otherwise we will be affected on our bottom line. And the ROIC, again, the long-term target is anything above 18, which is good. If you take an across industry report and look at how the ROIC margins are across industries, it's not that many that can deliver above 18% or higher. It's actually kind of only a few industries that are able to do that. So this is the long-term guidance. In the current Q3, we have delivered 16%, so we're getting there as well. And again, this is the progress. The ones that are green, they are in line with the long-term guidance. The ones that are yellow are close, and there's no one that is red, which is great. But the ones we've marked in yellow is because they're just shy of the guided numbers. But it'll be an exercise in utilizing your capacity to the best possible extent. So there will always be this tear on the bottom line, as long as we keep growing with kind of high double digits. So it is expected, but we are trying to balance it all. That was it for me. Thank you for your time. I'll happily take any questions you might have. I am the one to the left side of the screen, so you can get a face on me. Please, if you have any questions, let me know.
Thank you for that, Patrick. An interesting quarter again with some great growth. If you could cancel your screen sharing, I think it goes away, so we got our faces on the screen.
Yeah.
Oh wait, now I see yours.
Can you see me?
2 seconds.
There
we go.
There we go.
Okay. So yeah, like Patrick said, if you have any questions, just write them in the question field and I will ask them. But I'll start off with some questions of my own. So first I'm going to get into some financials. I mean, you talked a lot about how the growth affects the bottom line, but you also saw a slight decrease in the gross margin for this quarter. And I'm wondering, is this also because of the new apartments maybe taking some time to be fully operational, or yeah?
Yeah, it is. It is. There's always this delay in between, the growth and when that will materialize on the top line. There's also some timing on when it comes into the year. So if our quarter it's a 3-month quarter and a large part of the units has come in late in the quarter, then that will not have a complete revenue effect yet. So the units are coming in, but you'll not get the revenue potential just in the short run. We are trying to manage this. Obviously, we're trying to be as fast as we can to get new units into operations, but there's just this. It's a matter of getting people to run faster, so to say. So it's a delicate balance.
Yeah.
But yeah, basically the revenue potential will not show yet. But it'll come later in the year. Regarding growth in general, sorry, just we reported in the 30s last time. Last year it was in the 50s. Last year was still affected by COVID-19 restrictions, so that's why that was a bit on the high side. And then obviously there will also be this flattening effect. I do not. We let's see how it pans out in the long run. But unless we do something dramatically, being in the 50s is probably not. It's probably being in the 30s that is a bit more long-term kind of. Yeah, that's the potential as it is right.
I guess that answers my follow-up question. But I was just going to ask quickly if the expected margins in Sweden, are they the same as in Denmark for every unit, or does it differ anything?
It is expected to be the same. And again, the Swedish, if you look at the Swedish launch as it is right now, we have 44 units in Sweden, and some of them are rented out and all's good. But there is this, and we have a Swedish director in place that is doing a great job. She's very strong on the commercial side of it. Has a great network with the corporate clients. But it'll just take some time before everybody gets to notice you. So the vacancy in Sweden is artificially high right now, and that will have an impact on revenue just in the short run. In the longer run, when the market has matured, our company in Sweden has matured, we'll have organic growth in the local markets alongside new launches. Then our growth should be looking a bit more exponential than it is right now. Regarding the margins, it is expected to be the same. We are still, if you think about our total guidance numbers, the only one that where it's too early to predict is the revenue per unit, because that's reported in the Danish currency, and there is this there's obviously a currency difference between Sweden and Denmark. The revenue per unit is also a product of, larger units can obviously generate more revenue than smaller units, but smaller units are easier to operate. It's you can have the price points at a nominally very low or relatively low level, which is interesting to your local clients. So smaller units are easier to kind of rent out, but obviously the revenue potential is not as great as it is with larger units.
Yep, thank you very much. So if we're moving on a bit towards the expansion, I was first wondering how many employees do you currently have, and do you expect to hire a lot of new people in connection with the expansion, or are you well prepared for? Well, is the company prepared for a lot of expansion without having to hire a lot of new workforce? Great
question. We've hired a Swedish director, which is obviously to manage and drive the development of the Swedish company. In Denmark, we will be hiring a chief executive officer from January 1. This is to we could do without, but it's also realizing that we cannot keep we cannot keep just run faster everybody. I need to free up some time to focus more on the international markets, and that's why we have this specific hiring plan, a chief executive officer in the Danish market, to kind of put everything related to Denmark on her table, and having me being able to focus more on the international expansion, freeing up more of my time to do that and make that run smoother. We are 34 staff members in total. A lot of them is part-time employees and service employees, but that is so we remain fairly lean. But again, we are trading off in a way. We are hiring an officer or a director is always this weird exercise where you have to realize your limitations and that you cannot do it all. On the other hand, a chief executive officer can handle as many units as you throw at her. So we can easily grow to 1,000 units with that kind of wage cost on board. But we need to add some more experience and some more firepower, so to say, to our organization to allow us to keep growing at this pace, especially internationally. So that is the short-term substantial hire that we're going to do.
Mm-hmm. Sounds good. So if we move on towards the German expansion, you've talked a lot about what you have done with all the legal groundwork and the founding of the subsidiary. I'm just wondering what steps are left before you can actually materialize the launch.
It's getting some of the projects we're looking at. It's no secret we're looking at some different projects that will be well suited for our purpose. Some talks are more advanced than others, but it's basically getting that deal done, so to say. So getting some operator agreements in place on the current talks that we have. That is the next step. The lead time on the projects is then expected to be anywhere between 9 and 18 months. So if it's 9 months, then happy days. We will be able to plan the organization and the launch very meticulously before entering the market. So the next step is to get some of the talks to be specific and materialize, getting it down into a contract. Again, some are closer than others. Nothing is specific yet. And then step 2 is to build the local organization with a German director as the first natural step, of course. So to get a very good local resource in place, that'll be step 2. And then we would be good to go.
Yeah, perfect. And if I understand you correctly, you do not expect any more units in Sweden for 2022, right?
Nope, not in this year. We have a pipeline for the next year, but there's no more units coming into Sweden right now. We've entered this consolidation phase, so to say, as well in Sweden, where we have a good amount of stock on the shelves. So exercise 1 is to get everything rented out up until maturity, which means in our terminology that we'll get it up to where we only have the natural vacancy you will have from normal operations. You don't have any excess vacancy from steep growth or launches. So the current director is working hard on that exercise. When we have that done, we will reassume growth. And then hopefully we will expand to the key cities that I mentioned earlier, Göteborg and Stockholm. The director is also located in Stockholm, so Stockholm is her playground, so to say, or her home turf. She has a great network in Skåne as well, but she is located in Stockholm. So we will be moving the offices to Stockholm. That is where, again, no offense to any cities anywhere, but the capital of all countries is just where it's at, and it's not different in Sweden, like it is not different in Copenhagen. So we will move anything to Stockholm, and then we will take it from there.
Yeah, and the local expansion in Denmark does the focus there lie on finding new markets or expanding the current markets?
Yeah, it's a great question. There's a couple of interesting markets in Denmark that we do not yet cover, and we would easily be able to do some launches there if we wanted. But the current focus is on optimizing the existing stuff or kind of doubling down on the existing markets because it's easier. You are there already. You have the organizations in place. You have the clients. You have everything. So it's a less riskier way to grow. It's just to keep growing in existing markets. But there are some markets in Denmark, so I know my answer is a bit like a politician, But there are some interesting markets in Germany. In Denmark. Esbjerg is one major port city. There's a lot of green energy initiatives happening out of Esbjerg, so that would be extremely interesting, and we're looking there. But other than that, it's in existing markets that the growth is expected to happen.
Yeah. Okay. And if we move on to the group structure, as you mentioned, you added both a subsidiary in Sweden and Germany. Can you tell us briefly a bit more how this actually affects the group as a whole?
Yeah, it's what you can say is that it's having subsidiaries and operations mixed into one can be a bit messy, so to say, because the existing parent company is the Danish operations company. We've been thinking about redoing it, but for now it remains done like that, and it is manageable. So if you, I don't know what you mean by affecting, but obviously there's some investments needed everywhere that is drawing a bit on our cash balance. But other than that, it's business as usual. We are taking the Danish operations company is the parent company, and it will stay like that until someone that is more clever than me will come and say no, change it, or it would make more sense to have a holding structure or whatever. But it's not in the foreseeable future that we will do any massive changes. Subsidiaries are expected to be part of the current Danish parent company, which is also the listed entity.
Okay, quickly before I move on, I can just say that I have 2 more questions left. So if anyone in the audience has any questions of their own, now's the time to write them. So I just want to ask a quick question about the collective yo-yo. You mentioned that it's been put a bit to the side for this quarter, but when can we expect the full launch of it? And is there any like major steps you have to do before that, or?
Yeah, great question. No, it's true. It has been neglected, and it's been a calculated decision. We could see that doing the aggressive growth on our core kind of product groups would be more profitable in the short run. All the bits and bobs are more or less there to do it, but you cannot But the bottlenecks has been in the organization, to be honest. We have a lot of dedicated and hardworking service staff, and they can only run so fast, So when we've added almost double the amount of units that we did last year, or that we've kind of outperformed the guidance on units, that has been the focus, and they can't be 2 places at once. If we went in and did some additional hires to get the other product group off the bat, that would equally affect our bottom line margin. So we decided on that the growth remained substantial, and we wanted to balance the bottom line metrics more than we wanted to increase on that. That being said, when we shift focus in the short term, as I mentioned, for a bit more focus on cash flows, we have all the ingredients to bake the pie, so to say. So the furniture is sitting in a warehouse. We have the IT department in-house that is working on all the management systems and the outlets and all that needed to do an efficient and commercially viable launch. So to answer your question on what is the hurdle rate, that is to have our IT department build a stellar product, and we're working on it. I'm sure it'll be great. We have to build a very advanced warehousing system, kind of stock management system, and then you have to tie that to a front end, and we're currently doing that. So we expect to launch it in the early part of next year, and we're getting a lot of requests. We have a lot of clients who wants the product, but we just haven't had the manpower to execute on it, and we didn't want to do it before we had the very good kind of IT products, because if you do that, you'll just run around with yellow slips in the shop, so to say, post-its everywhere. It'll be a complete mess. It'll take away from the client experience. So when we have this super nice IT product in place, we'll do a launch, and the furniture is sitting in a warehouse waiting to get out and activated. So that's the hurdle rate. And when we won't be adding this aggressive unit number, we'll have more than enough manpower in the existing organization to also deliver a nice experience on that one.
Yeah.
So that.
Okay, so for my final question, it's about your upwards revision of gross investments. As you mentioned, you'll change strategy a bit in the Q1 and Q2 for 2023. I was just wondering, is this higher amount of investments expected just in Q4 for this year, or do you think it will continue? Or I'm guessing it's going to go back to more normal levels in Q1, Q2.
For sure, it's expected to continue in Q4, and then it should stagnate completely. Right now, there's a very one-to-one relationship between our growth and our investment rates. It's not any different than anybody who wants to build a factory or whatever, you know, or buy a lot of cars, or I don't know, you know, it's assets, and assets is expected to generate a return. If we can generate a return on assets or on the invested capital in the region of 16 or 18% plus, then that will be impressive, you know, on a standalone basis. However, we are working on improving this. We are working to see if we can get our cash to stretch further than it is right now. And if you look at the way we grow in Denmark, we pay cash deposits to our landlords, and then we invest in furniture. So that's the two major investment items. So we are working on different means to not make it as one-to-one. Guarantees being a product. In Germany, we have there's these insurance companies that are doing rental guarantees. So you can post a rental guarantee. It'll be a financial item instead of it being a tie-up in cash. So that's an interesting concept for us. We are working on bringing, you know, developing on that across all markets, so that we won't have this need to post cash securities. But that'll be a massive improvement on our tie-ups. It'll also mean that our cash reserve will be completely different. So that's just to give you an example of one of the stuff we're working on right now, to not make it as to not make the growth kind of this. It's not cash heavy. Again, having an ROIC of 16 or 18 is great, but we want to make it even better.
Yeah. Well, that was my last question. So thank you very much for your time, Patrick. Unless you have anything else to add, I guess we'll see each other next time. So thank you.
Thank you, Johan, for for managing this and hosting this. Very happy to take part of it, and see you next time. It'll be the full year thing. That's exciting.
Yeah. Well,
good stuff.
See you then.
Thank you.
Goodbye.
Everybody.